Hello everyone. Today we're going to talk about stocks. What they are, how they work, and why stock prices go up and down. If you've never invested before, that's completely okay. This video is made for everyone, including beginners, people who may have heard the word stock, but aren't totally sure what it really means. By the end of this video, you'll understand stocks in a simple, clear way, with no confusing words, no complicated charts, and no experience needed. Learning exactly how stocks work before investing in companies helps reduce mistakes and build confidence over time. So take a deep breath, get comfortable, and let's get started. So what is a stock? A stock is a small piece of ownership in a company. When you buy a stock, you are buying a tiny part of that business. This is one of the most important ideas to understand, because when you own a stock, you are not just guessing on a number going up or down. You are actually owning part of a real company that makes real products or provides real services. Imagine a pizza being cut into 100 slices. If you own one slice, you own 1% of the pizza. That one slice belongs to you. You don't own the whole pizza, but you still own a part of it. A stock works the same way, except instead of pizza, it's a company. If you buy a stock in a company like Apple, Nike, or Amazon, you become a part owner of that company. Even if it's a very small part. You probably won't be helping run the company or making decisions, but you still share in the company's success or struggles. Why do companies sell stocks? Companies sell stocks to raise money. Running a business costs a lot of money. Companies need money to grow, improve, and stay competitive. They might need money to create new products, improve technology, hire more employees, open new stores or offices, and expand into new countries. Instead of borrowing money from a bank, companies can sell pieces of the company to investors. When people buy those pieces, the stocks, the company receives money it can use to grow. In return, investors hope the company becomes more valuable over time. How do you make money from stocks? There are two main ways people make money from stocks. The first way is if the stock price goes up. If you buy a stock for $10 and later sell it for $20, then you make a $10 profit from that stock. This is called a capital gain. It happens when a company grows, becomes more profitable, or is seen as more valuable by investors. The second way is through dividends. Some companies pay investors a small amount of money just for owning the stock. This is called a dividend. Think of it as a thank you payment. Not all companies pay dividends, but when they do, it can be a steady way to earn income over time. How do you lose money from stocks? Just like you can make money from stocks, it's also important to understand how you can lose money. This is especially important for beginners. There are two main ways people lose money in stocks. The first way is if the stock price goes down. If you buy a stock for $20 and later sell it for $10, you lose $10. This happens when the company's value drops, or when investors no longer feel confident about the business. A stock price can go down for many reasons. Some of these may include the company earning less money, bad news about the business, problems in the economy, or simply fewer people wanting to buy the stock. If you sell the stock for less than you paid for it, that loss becomes real. The second way is selling at the wrong time. Sometimes people lose money not because the company is bad, but because they sell too early. Stock prices move up and down all the time. Seeing a price drop can feel scary, especially for new investors. If someone panics and sells during a temporary drop, they can lock in a loss, even if the stock eventually goes back up in price. This is why many long-term investors focus on patience and learning instead of reacting emotionally. You don't lose money just because a stock price goes down, you lose money when you sell for less than you paid. Understanding this helps beginner investors avoid making emotional decisions. What makes a stock price go up? Stock prices go up when more people want to buy the stock than sell it. This is where supply and demand starts to matter. If the company is making more money, this usually causes the company's stock to go up in price. If a company earns more money than expected, investors usually get excited. For example, if a company is expected to make $1 million, but instead made $2 million, that tells investors the business is doing better than planned, which often causes more people to buy the stock. Good news also plays a key role in a stock price going up. Good news might include Strong sales numbers, a popular new product, expanding into new markets, and positive media coverage. Good news usually leads to more buyers, and more buyers usually leads to a stock going up in price. A strong economy can increase stock prices. When the economy is doing well and people have jobs, companies often perform better. This creates confidence, which leads to more investing. Investors' confidence alone can increase the price of a stock. Sometimes a stock goes up simply because people believe in the company's future. Even before profits increase, belief and optimism can drive prices higher. What makes a stock price go down? Stock prices fall when more people want to sell than buy. Poor earnings can cause a stock price to go down. If a company makes less money than expected, investors may lose confidence. Bad news can most certainly cause a stock price to go down. Bad news may include lawsuits, product failures, company scandals, and leadership problems. Bad news often causes people to sell shares of their company very quickly. Economic issues can cause a stock to decrease in price. Inflation, rising interest rates, or recessions can hurt stock prices, even for strong companies. Fear and panic also can play a role in a stock price going down. Sometimes stock prices drop simply because people are afraid of losing money. This can happen even if nothing major has changed with the business. Whenever people are in fear of a stock price going down, they will usually sell their shares in the company so that they don't lose any money, but this also means the stock price may fall because shares of the company are being sold. Supply and demand of a stock is the most important factor of a stock price and will determine if the stock price is going to go up or down. Stock prices move because of supply and demand. If there are more buyers than sellers, then the stock price goes up. If there are more sellers than buyers, then the stock price goes down. Prices don't move randomly, they move because people are making decisions on that particular stock. If you're new to stocks, remember these key takeaways. Start slow. Nothing great happens overnight and growth in companies may take time. Take calculated risk, and don't invest expecting to become a millionaire overnight. Learn about a company before you invest so that you become educated on why you think that company is worth investing in. Don't panic when prices move. Think long term. Although you are taking a calculated risk, stocks are not gambling, they represent real ownership in real businesses. And most importantly, think with logic, not emotions. As a beginner investor, you may feel so many different emotions, whether good or bad, but it's very important to stay disciplined and emotionally stable when taking these calculated risks. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.